Uh, so, Once again, good evening, everyone. Thank you so much for coming. Today will be the conclusive day for the seminar which we started day before. So, the idea for doing these 3-day session was that we touch every aspect of investments and trading. Obviously, it's not possible to wrap up everything in 3 days, but we can always try to cover as much as we can. And that is the idea. So, whenever we learn or whenever we understand how markets work, it will not take one day, 1 year, or 10 years to finally get it right. There will always be a chance where we will see that something what we predicted or what we estimated did not go right. But after a certain point of time, we'll embrace the riskier element of it. What is one thing which is inevitable in investments? It is the risk. We can try to avoid it, but we cannot remove it completely. And that is the reason why we always try first to diversify, second, to manage risk in a manner where even if we have to book a loss, we do it and then we move forward the next day. This is something which years and years of trading and understanding have taught us. We share the same thing with you the way we learned. And if you see last 2 days when we have been tracking the prices of a few of these products, so this has to be habit, something which I do every day. Look at the watch list, look at the highs and lows. But I do this with you. Throughout the day, what I'm doing is every 30 minutes or every 1 hour, automatically I just glance at this list. Don't really have to spend 10-15 minutes looking at this. It has to be a glance. So whether it is gold or crude oil or currency, we just have to look forward to it and we have to understand that how the market will eventually work and how these kind of prices move. Just 1 second. So if we start from today, look at gold prices right now 3036. Yesterday's close 3047, very close to 3050. Lowest yesterday was 3025. Highest it did go to 3058. Now let me remind you, before we began this session, a day before that, gold was reaching towards 3000. In last 3 days, it has moved easily around $58. Came down as low as 25. Right now it is at 3035. Yesterday evening, Central Bank of US issued a statement which was about interest rates, whether to make loans more expensive or not. And they agreed on the fact that the interest rates are going to be the same for some time. They did talk about some uncertainties which might happen due to tariffs coming in. As of now, Trump tariffs is a bigger threat to the stock markets. That being said, Donald Trump issued a statement saying that central banks should keep the interest rates lower. This is not the first time he has done this. Back in 2016, 2017, when he used to be the president, he often used to come out and say things like, Fed would be completely crazy if they increase the interest rates. Now you have to understand, if interest rate remains lower, that favors the stock market, right? Because cheaper loans means more opportunities for the companies to borrow money, more expansion, more economic activities. But while the interest rates remain low, we also are under a threat of tariffs coming in, which could increase inflation, right? So we are stuck halfway. If central bank does not increase the rates in the future and inflation comes in, that would push people eventually not being able to afford basic goods. US does not want inflation again to go to 9 or 10%, because that would be a state where it will be very difficult to control that. But at the same time, they also want to make sure that interest rates are lower enough that it keeps the markets motivated to do business. So what should happen? Eventually, either the tariff threats should be cooled down, either So, like how it happened years ago, this started with a bigger tariff threat, spread across the world. Eventually, every country started coming on to the point where they would control the tariffs and do not put exactly what they have said. This is one possibility which could happen. As of now, we are still talking about tariff as a threat. So, what will happen eventually? Would they postpone it? Would they delay it? Would they reduce the percentage of tariff which they are going to put it? These are the key points which every day is going to change this watch list. So, if you see gold, look at silver. So, while gold is down today by 0.3%, look silver. It is down by 1.2%. Yeah, remember, we were talking about that what happens when a tariff threat comes in. Of course, there is uncertainty, so people are motivated to buy gold, but they are not motivated to buy silver because silver is more of an industrial metal. That is why silver is going down more than gold. We'll also learn a strategy where how we can take advantage of these price differences today. If you see oil, both the oils, again, similar direction, look at the percentage increase, 0.11%, 0.17%. Moving in the same direction, even the same percentage increase. Wheat down by 0.5%, coffee down by 0.9%. Look at stock markets. But this is where it becomes interesting. Look at Hong Kong today, down by 2.7%. So today was the interest rate decision and Central Bank of China decided to keep the interest rates same. Now, China is on a different trajectory, right? While the world experienced inflation, China experienced deflation. So for them, not making loans cheaper is a problem because they need more cash in the business. They need more liquidity in the business. That is the reason why Hong Kong index is down 2.7%. And this is a big dip for a day. So let's see which other products showed positivity. So yesterday when this statement came up that interest rates are going to be same, not higher or lower, we saw stock markets pushing higher. Look, Tesla, if you remember, yesterday's low was 228. It closed at 225, but highest was 241. For an intraday trader, not bad. As a point of entry, again, not bad. So what we were talking about yesterday, if when we were looking at the chart of Tesla, this is where we were, right? Kept talking about this level right here. You see how this level still remains strong as a support. It did not break this level, again bounced back. Now, the entry points, as we were talking yesterday, the entry and exits need to be planned in a manner where we are able to reduce the probability of a loss. So if I enter at support, exit at resistance, that is how every trade needs to be planned. The stocks we were talking about yesterday, if you see when the central bank news came, I will reduce the duration of this chart, so you can see the impact of the rise and fall. So let's say 5 minutes. This is after the session was over. Look at the time, 10:30, 11 o'clock, that is when the press conference happened. Look at this rise. From here, which is 234, it went all the way up 241 and then came down 235. And as we were looking at the stock yesterday, it was 228. This is the amount of movement which has happened in the stock markets. I will also show you a US stock market index. So this is called US 30. Add this to your list. Look at this. Same time when the stocks went up, look what happened to the index that we are looking at. It was at 41,678 here, 41,680, went all the way up here to 42,160. $600 bounce from 10 o'clock to 11. In 1 hour, it moved up by $600. So what we were talking about yesterday, you don't really need huge quantities, but you need to know what is the average range of something. That will help you to decide your quantities, right? Now, when something like this happens, where do we stand as investors? As traders, obviously, when I'm looking at a watch list, I would be more intrigued to do intraday. If you had seen Bitcoin also yesterday, moved crazy, went down to 81,000, moved up to 85,000, $5,000 in Bitcoin also. You could trade in 0.1 unit, 0.2 units very easily. Look at Solana, look at Ethereum. Everything moved higher yesterday after the central bank decided that they are going to keep the rates lower. Tariff threats are real. So that is what has pushed the stocks today. But every day a news is coming. So why this market is very interesting. Why Donald Trump, these next 3 to 4 years, why this is going to be really interesting. Because if you end up being on the wrong side of the trend, you might still end up exiting that trade in profit, because every day there is something new. This is not normal. 4 years of heightened volatility is what we are seeing. So yesterday, somebody who short sell stock markets would book profits today. Somebody who bought stock markets yesterday would have profit yesterday night. That is the power of volatility. It is bringing you a lot of opportunity. You don't need to be scared, but you need to diversify more. So now I'm going to show you something very interesting. Okay, let's have a look at this. S&P 500 as an index recently dropped. A correction came into it. And if we study this, let's go point by point. So March 13th, S&P 500 closed lower more than 10% from its February 19th peak, entering into a correction territory in a span of just 16 days. This is a big drop. Since 2000, S&P 500 has experienced 9 corrections. Corrections means when markets drop. So a 8 to 10% drop comes under correction. More than 10% or more than 20% becomes a crash or a bear market where it starts. Here we see that since 2000, US 500 or S&P 500 has experienced 9 corrections, average loss 14% over 83 days. Recovery took an 86 days with a 9% return in 1 month, 20% in 6 months and 26% in 1 year, 72% over 5 years. So what they are trying to show you is here on the table. So look at this. So these are the past corrections which have happened. So if you see 2002, 2010, 11, 15, 18, 23, 24. These are the dates when S&P 500 has fallen down, and percentage loss 15%, 16%, 19%, 12%, 13%. On an average, 14% loss has happened in these corrections throughout these years, every time a correction happens. Recovery period, so number of days the market is down, on an average 83 days. Time takes for the markets to recover around the same time, 86 days. Once it recovers, the returns post that in 1 month 9%, 2 months 11%, 3 months 14%, 6 months 20%, 21, 26, 5 years 70%. Basically what the flyer is made to make you understand that when you enter into these corrections, from a long-term perspective, it may be the right time to enter. Okay? Because if you are a kind of person who want to invest for 4 or 5 years, for example, if you want to invest for 4 or 5 years, it could bring you a good opportunity. And as I said, we can make ladders of this. You do not have to put everything together. So today, if you were to invest $50,000 in S&P 500, you could start with 10,000 now. If you feel that there is further correction coming, then you can put another 20,000. More 10% correction, you can put another 30,000. But entry is really important. If we just try to sit on cash thinking that we are going to time the market, so let's just understand this will not happen, where goes down, it goes down and then bounces back, and you are able to buy here and very easily sell here before it drops again. Never be able to do this. No one can do this. Timing the market is not possible. Today, if you feel that right now markets are going down, I will enter when it starts going up, you don't know that. Nobody knows that. Team of 50 consultants sitting there, they don't know that. They do the best they can. But can they write it on a piece of paper, tell you that this is exactly where the market will recover from? No. That is why we have to take every chance we get to enter. This is that chance. If I show you individual stocks, look at this. So I showed you the correction category. I'll tell you what happens when S&P falls more than 20%. Then we enter into a bear market, right? Then we have to accept we are all in this together. So what we see this has happened 4 times when S&P has gone down more than 20%. See, 49% down, 57% down, 34% down. In 2022, 25% down. So on an average, since 2000, in last 24 years, 5 times it has happened where S&P has fallen down more than 20%. For how long that bear cycle stayed for? At least a year, more than a year, 1.5 years. How much time it took for S&P to recover? Around the same time. Once it recovered, look at the 5 years return, around on an average 121%. And this is not something which is new, because understand S&P 500 has 500 US companies. A lot of them tech, financial services. So if you see here, I'm going to show you one very interesting chart. This is Tesla, right? Look, 1 year return. So today is March 21st, 2020. 20th March, right? I remember 5 years ago, this was the same time when the lockdown started. This has been a 5-year anniversary to pandemic. Can't even say happy anniversary, it was very sad. So look at 1 year performance of Tesla. So 20th March 2023 or 2024, from 20th March 2025, 37% up still. But if you see 5 year, 727% increase. 727% increase. Same 5 years, this is from pandemic till now, right? But again, that is pandemic recovery, right? But if you see stocks like Alibaba, for example, 5 year increase, down 20%. But if you see last 1 year, 95% up. This is the same time where so many investors would have been scared of investing in China because the markets were down due to real estate, due to anything. They must have been thinking that right now it's not a good time. I will invest when market starts going up. Well, from last 1 year till now, it is already up 95%. This is one opportunity which you missed. So when someone asks you how much money we can make in 1 year, it really depends where are you investing. Because at the end of the day, these kind of companies, they come down, they stay down for some time, eventually the stock moves higher. So the power of being invested in markets, it is really important. It's not even about trading. So I always feel there are ways to do this, right? You trade, but that is short term, right? So what do? Divide 2 of these things. One is your long term, and then this is your short term. Long term is your investment in bonds. You earn fixed income over it. You invest in some stocks. So let's divide this long term into bonds and stocks. Let's divide the stocks into value and growth. Value is, it will give you fixed dividend, right? Fixed dividend. Growth is the tech companies. Within this growth, 2 kinds of growth. One is Apple, Amazon. One is the futuristic markets, space exploration, 3D printing, cyber security. In bonds, there is government bond and then there is corporate bond, right? You're sorted. You have your long terms planned already. You want to touch it when the returns are higher, you can. The short term can be divided into strategies, which we will understand today. We do not expect you to be in front of the system 24 hours and try to do this. Why? Because obviously you have your jobs and it will be difficult for you to just be around and keep looking at the market. So what we do, we come up with different strategies and different ideas. So we start with something called a pair trade, right? We are talking about oil for so long. We have to understand how to exploit the market when we get this opportunity. So Anis, you can share the PDF on the Zoom also, right? So how we take advantage of this? So first thing is we saw that both kind of oils, they're moving in similar direction, right? So today we saw that crude oil, while one is up by 0.11%, another is up by 0.17%, but both are moving in the same direction. Let's have a look at what is the actual oil price. So we are looking at two oil prices right now, Brent and WTI. This is WTI and this is Brent. So one is here, is here. 71.13, 67.35. If I'm not wrong, somewhere around $3.8 maybe the difference. Now we have to understand this difference which we are talking about. Is this always $3 or $3.8? No, it changes. In fact, if very quickly I was able to show you, this is called Brent WTI spread, which shows you the difference between the prices or for both Brent and WTI. Look at this. In last 3 years alone, this graph, what you see, this graph is not oil prices. This is the difference between both the oil prices. Just look at the peak, how high it has gone. $12, which is right now $3.5, $12 movement, which means WTI could be 60 and Brent would be 72. That much difference. If you see the lowest, look at this. 33 cents negative, which means at some point of time, WTI became more expensive than Brent. Now the point is where we stand right now. If we see right now, shows around 4.09, $4 difference. But in January, it was how much? 2.08. So can I say from January till March now, the price difference has gone up by $2. How would you trade in this? First of all, two things I would like to highlight. It took 2 months at least for this price difference to move from 2 to 4, which means the spread or the difference between Brent and WTI, it is not as volatile as the oil prices. Oil prices could move. In 2 months, oil was 75, it came down to 65, moved by $10. But the difference between Brent and WTI, it kept around the same, but it moved by $2 up. How would you take advantage of this? If you're a kind of person who does not have the time to trade or would like to take opportunities as and when it come, what you do, the Brent, which is right now 71, and let's say WTI, instead of being 67, it was 69, $2 difference. You expect this difference to get bigger. What would you do? So if right now the difference is 2 and you expect it to become 4, how this will reach here? Either this will go up or this will come down. So what you do? You enter into a statistical arbitrage. How you do that? You buy equal quantities, let's say 1000 barrels of Brent, and you short sell 1000 barrels of WTI. How will you make money on this? Because you know both move up together, both go down together. So the question is, how will you make money? Because if this goes up by 0.1%, this will also go up by 0.1%. So you lose 0.1% is there because it's a short sell. You buy, you will make 0.1% here. So it's neutral. The thing is, when we are talking about arbitrage, we expect one of the trades to outperform than another. So consider it a race where Brent and WT are both running. They're moving at the same speed. But at the end, only one will win. So if you buy trade or your sell trade. So if the oil prices move higher and if it starts going really high, you expect your Brent position to perform well than WTI. So your loss, your short selling loss in WTI will be less, but your profit in the buying position of the Brent will be higher. This is not something which changes a lot every day. In fact, as we saw, it took 2 months for this to happen. 2 months from January till March that the spread moved from 2 to 4. Imagine this while we are looking at our long term investments, being very patient about it. Let's see the portfolio. One of this becomes Brent WTI strategy, right? I've still not asked you to do short term trading. Short term trading is a 50-50 thing. It does not matter who tells you what. There is no such thing as guaranteed return in trading. You put 10 algorithms, you do the best research, you change your platforms, it doesn't work. It is all about speculation. You're on the right side of the trade, you make money. You're on the wrong side of the trade, you lose money. That is why it is important that you make peace with the fact that my day is over, my day trade is over. Next morning, I will wake up with the biggest smile and see the trend again. It is as simple as that. There is no other way to change it out, right? Now, there is one more strategy which you can do. So while we do this in Brent and WTI, right now this opportunity is still not there because if you see on an average, the price difference has been around 4. When this opportunity comes, that is why consultants are there. So whenever you open an account, you get a consultant. Whenever this kind of opportunity comes in, the consultant would tell you that, see, so the difference is now $1 or $2. It's a good time to enter because historically we have seen that on an average, this gap is $4 to $5. So whenever this gap comes down, you buy Brent, you short sell WTI. On a live platform, it is very easy to do this trade. So what you will do, you have your watch list ready, equal quantities. So right now it is already 4. So let's say instead of the spread going up, I'm expecting it will come down back to 2. So in this case, I'll go opposite, right? In this case, if I'm looking, let's say the gap is 4, this is Brent and this is WTI, and I'm expecting this gap will reduce to 2. So either this will come down or this will go up. So I buy WTI, I short sell Brent here because this is the opposite. If we again expect from 2 it will become 5, so this should go up and this should come down. So we keep changing this. And as I said, this is not something which you have to do every day. This is once in a while, whenever the spread comes down, you can take advantage. So let's say I'm expecting from 4, this gap will reduce to 2. So what I do, short sell 1000 barrels Brent, confirm and place my order, and at the same time buy WTI. Now if you see in your positions window, This trade has been executed. Now very closely look at this. You see the loss right now, which you see 271, right? See how often with 1000 barrels this 271 changes. If it was 1000 barrel of just oil, not a pair, you will see movement happening a lot. Why? Because 1000 barrel is a big quantity. 1000 barrels is basically around, you're looking at $70,000 worth of oil. You could always do it with a lower quantity. But if you see right now, even the oil prices would move. Your loss amount is still the same. Why? Because they're both moving in a similar direction. So right now your trade is locked. The profit will only happen when the price difference between them increases. So right now the price difference is 4. Sorry, in this case, when the price difference reduces, that is when you are going to make money. When you will lose money, if the price difference increases. In case, if the price difference was 2 and you speculated it will go to 4, you entered into a trade. So if it goes to 4, $2 up, 1000 barrels, you make $2,000 profit. But if it goes further down than 2, you are making a loss. So this is not something which is risk free, but it brings less volatility to your portfolio. You have to understand the part of strategies is not just about making money, it is also about reducing or minimizing a loss. Try to outperform the markets. Imagine this, a pair of South African index and Nasdaq. Nasdaq is a US index which comprises of 100 tech companies, right? It shows the performance of 100 tech companies. South African index, on the other hand, representing the performance of companies in Africa. It's a commodity based index, South Africa. Nasdaq is tech. What if I tell you in last 20 years, there have been 3 or 4 occasions where South Africa has actually outperformed Nasdaq, but remaining times it has always been Nasdaq which has outperformed South Africa. What do we mean by outperform? So in this case, if South Africa index moved up by 10%, Nasdaq moved up by 15%, who outperformed who? Nasdaq outperformed South Africa. In case South African index went down by 10%, Nasdaq went down by 8%, who outperformed? Nasdaq. Outperformance does not only mean when the prices are up. If I performed bad, but a fund manager next to me performed even worse, then I outperformed that fund manager. So I would tell you that for 20 years, year on year, it has been only 4 occasions that South Africa has outperformed Nasdaq. Only 4 occasions. Rest 20 years, every year Nasdaq outperforms South Africa. So if you buy Nasdaq at the beginning of the year and you short sell South Africa at the beginning of the year, most likely in terms of, if we speak statistically, higher probability of you making money rather than losing. We can look at it. So let's say if I write Nasdaq futures, okay, let me see this. Okay, last 1 year and sorry, what is it? Essay? Will we find it here? No. Okay, let's say year till date. Now, if you see this, South Africa ETF. Okay, just looking at the ETF versus index performance, so not completely accurate. But if you see here, right now, year till date, the South African ETF shows an increase of 9%. Year till date, which is 2025 till now. You see NASDAQ, it shows down, right? Down by 8%. But if you look at throughout the year, higher are the chances where we will see, if we calculate the actual index, because this is just an ETF, you will see eventually South Africa ending up with a lower return than NASDAQ. And fundamentally, this is how it is supposed to be, at least for this particular year, because NASDAQ it still comprises of the tech companies, and these tech companies are the biggest. We are talking about trillion-dollar companies. South Africa, while it still continues to struggle between power outages, still political instability, and a lot of other factors, it impacts the index also. So there are pair trades which can be done between two indices also. So while we are looking at Brent WTI, we are looking at two different indices from different economies. We also can look at something which is called gold silver ratio, because right now we have seen enough that how gold and silver, they move in similar directions, but times like this, when there's a lot of uncertainty and when there is a lot of volatility, how do you protect your portfolio during the higher commodity movement? So look at this chart. Okay, this chart, what you see right now, I'm going to go 5 years back. Okay, what do you see right now here? This is not a chart of gold price. This is not a chart of silver price. This is a chart of gold silver ratio. This is gold price divided by silver prices. This is called gold silver ratio, which right now is $91. It moves up when gold price go up and silver price goes down. It also goes up when gold prices move higher than the silver prices, right? It means that if I expect this ratio to break this resistance and move higher, I will buy gold and I will short sell silver, right? How much this ratio moves in a day? Right now, it has moved up by almost $1. $1, which is around 1% increase, right? It has moved up by 1%. How much it moves in 1 year? So if you look at year till date, since 2025, the lowest 87, highest 92, currently it is here, right? So can I say, as per the year till date chart, if the ratio moves here or when it is somewhere around here, can we expect this to come down back to 88? What should I do if I expect this ratio to come down? In what cases the ratio will come down? So if this is gold, right? Gold should come down, silver should go up. That is how the ratio will down. Imagine you doing naked trades in gold or silver, which you don't know where it will go, putting a stop loss or speculating on this. This is less volatile. This is something different from the normal gold and silver trades, what you do. And this is after when you have done your long-term investments. This is after when you have put your day trades and everything. This is more towards strategy, guys. So if you really feel that you are the kind of person who does not have time to look into the markets every day, you can do trades like this. See where will be the loss. Loss is that you are expecting this ratio to fall, but the ratio increases further. What will happen in that case? Gold has moved up, silver has come down, or silver has moved less than gold, which means you are losing money here. But look at the range of this 91, 88. You can do in outs between this. But how much it would move? In last 3 months, the lowest has been 88, highest has been 91. It has moved by $3. If you see last 1 year itself, see what has been the lowest in last 1 year? 74. Highest 91. But if you look at this range right here, which is December 2024, look at this range. Look at this. Bounce back from here, bounce back from here, bounce back from here. Now, if this comes down back to 87, what you should do? You buy gold, short sell silver. Again, expect the ratio to go higher. So, this is something you could do with any amount of money. If you have opened an account with $10,000, you could put 1,000 also. But obviously, these kind of pair trades, if you do with higher volumes, easier it is to exit at a smaller price movement. If you do it with lower volumes, then you might have to wait for the ratio to go higher, which could take time. So you don't want that. So that is why if you ever feel, like a lot of times when I sit with the clients, they would ask me that, if I want to put $200,000, I don't want to do day trade with it, right? I don't want to do long-term investments because I already have done long-term investments. What I'm going to do with this $200,000? You do strategies with that kind of money. Don't do just day trades with bigger amounts. You have $500,000. If you end up doing day trades with it, it will be too much for you because with $500,000 you want to utilize it all. When you really want to utilize it all, you have to take bigger trades. You take bigger trades, you would want to keep a stop loss, but let's be very mature. We know each other enough on human understanding that we are not going to put stop losses, right? We're going to act exactly like everyone else. 95% of the people who lose money in the market, why they do? Because they don't put stop losses. They take over leverage. Each one of us does that. I have done it so many times. Stand here, tell you about stop loss. You see my trading accounts right now. Doesn't have a stop loss. Because we always have that conviction that it's going to come back, it's going to pull back, it's going to work out. How many times it happens? Very less. So while we have our day trading portfolio sorted, while we have our long-term portfolio sorted, we can do strategies like this. We can do Brent WTI spread. We can do an index-based pair trade, or we can do something which is more on the lines of gold-silver ratio, right? That is also something which is available, and this is an everlasting trade. Does not stop. This is not the chart which we have made. You go back all the years which we have seen. Look, since 1966, 1968, this is the entire which it has been. Look at this peak. Look at the ratio where it was 126. What was that year? 2020. What happened in 2020? Why the ratio is so high? Gold skyrocketed because of COVID. Silver went down because of lockdown. So we saw gold jumping so high, silver going so down, ratio jumped to 126. Right?
But when you look at this again, doesn't this come under the long-term range?
So the ratio, as I said, so if you see last 3 months, the movement in the ratio is from 87 to 91, that kind of a range, right? But in one day, if we see, 1% movement has happened. I would tell you that in times like today, yes, back in 2012 or 2013, the movement will not be that much. But in times like today, easily 0.5% movement happens day on day. So if your volumes are higher, you could be able to exit in every 2 or 3 days. That is something which can happen. But you have to have that mindset also. See, if you were to put how this trade will be executed. See, so while we did equal quantities with the Brent and WTI, how gold and silver would work. So if you look at gold price here and I look at silver price here. Because the prices are very different from each other, we cannot do equal quantities. So what we do, let's say if we expect the ratio to increase further, right? Or it's already at 91, so we expect it to come down. So what we do, we short sell gold, and here we put amount, say $50,000, or the quantity 16 ounces. Confirm, place my order. So I short sell gold and I buy the same amount of silver, $50,000, somewhere around the same quantity, maybe 1500. Right. Now, if you see in your account, this is what it looks like, right? The quantities are different, but almost the same amount. You will have to see this. This is a pair trade. Opens together, closes together. Sometimes we make a mistake. We see the one which is in profit, we close it and wait for the lost one to get recovered. That is not the strategy. That is again speculation. Strategy is opening it together, closing it together. At any point of time, if you start seeing profit in this gold and silver net profit.
So we cannot keep a TP or a SL in this?
So not actually, because if you keep a take profit in one and if it gets hit, then your one position will be open. We opened it together as a ratio trade, not as a directional speculative trade. So we open it together, we close it together. See, you can always choose to do what you like to do. Like if I see a profit in this position, I would be able to close gold and wait for silver to come back. But that will become a speculative trade, not a pair trade. So, yes, sir.
In a bull call spread, it's a one line item, right?
So the spread is the price difference.
In the bull call spread of the option,
Bull call spread.
yeah.
So that is in the options.
One line item that once you execute, both will be.
In a way. So what you do in a bull call spread is,
They actually calculate the net already, right?
yeah. So in options, how the bull call spread would work, that let's say we are buying a call option for Amazon, for example. So you buy two options, you buy one call option, you short sell one call option,
You execute at the same time.
execute at the same time.
You close at the same time.
Yes, the expiry of both the options have to be same. But that trade is done to reduce your cost, because when you buy a call option, you pay a premium. When you sell the call option, you receive something. So your net cost is reduced. So something like right now, a lot of people are doing bull calls in Teslas and Amazons. This is slightly different.
Yeah, that is different. You have to close both of them.
Both of them together.
Separate
Yeah.
You
No,
can't
no.
do it one
Same
with.
So you have to close it at the same time.
But it'll be slightly different.
Yeah.
Unlike the bull call spread, whereby it's only a.
Because that is more of a, what you're saying is, it's more of an option-based trade. It will work only when you close them together. Same for this also. But there, when the option is close to the expiry, or when you close, or when the option expires, both of them will close out together. Even in...
My point is that one bull call spread is convenient. It's a one line item. It actually calculates the net profit or loss.
Sir, it calculates, so basically it gives you a limit to your profit. You cannot make more money than that. So if you are thinking,
Sure.
yeah, so
Yeah, but over here you have to calculate manually.
you have to close manually, correct,
And you have to close manually.
together,
It's a two-step.
two-step process,
execution.
correct, sir. But in this case, the profit is uncapped. If the ratio keeps going higher, you can make more money and you can continue to hold on to it perpetually. Like there is no expiry date to this. In your options, when you do a bull call spread, you have a limited profit in that, because you have bought one option, you have short sell one option. So your profit is limited. But
You can buy more.
sorry?
You can buy the quantity. You can increase the quantity.
Yeah. But even the same way, sir. So let's say you buy one lot or you buy 10 lots, but your profit of $200 is going to be the same. That profit distance is going to be $200 only if you have decided. Because in a bull call, so bull call spread is taken to lower your cost and limit your profit.
But it's a shorter time.
It's a shorter time frame. So if you take a weekly option, you will get to results. This could take,
short or long.
yeah, this could be short or long.
Just show me again that
The positions, yeah.
stop loss and take profit.
Yeah. So here, let's say, so this is what we have done, right? We have bought equal quantity of gold, right? And we have almost bought equal value, 50,000, 48,000. And if you see, there is a loss of 69 and 6. So basically, this will continue like this until one of either gold or silver shows more profit than other. That will happen eventually only when one outperforms another. Now in this case, because I'm short on the ratio, I'm expecting ratio will fall. So we expect gold to underperform than silver, right? So either gold falls more than silver, I have a short selling profit, I have a loss in my buying position, but my short selling profit is higher than the buying position.
But when you enter this stop loss and take profit,
Stop loss, take profit, you can do it from here. So just has to expand the positions window and you will see at the right corner here, which is called edit trade. Okay, click on edit trade and you will get a window to put a stop and take profit.
And what I'm saying, okay, in this particular stop loss and take profit, okay, you can do both together or sorry,
You can do put together.
or you can only one you can take.
In this case, you can put both. So let's say you put,
Suppose you just have to take a stop loss, for example,
yeah,
and not take profit, okay.
okay. So you can just put, yeah,
No, suppose I bought one stock for $100, okay, and I want to put a stop loss for 98,
correct,
2% less, okay,
correct.
and I want to take profit, I'll keep open.
Okay,
That's fine.
you can do that.
You can do that.
You can
right?
do that. You can.
No need to. I have to make sure take profit.
No need to. So when you see the window like this, just click on this cross to remove the take profit, like here.
Like show me this.
See, this is take profit.
Okay.
Click on this green cross right here,
Okay.
and you will be able to remove take profit. So you don't have to put take profit anymore.
Okay. Now
You can just put a stop loss, modify this. So this is modified. Now if you go back to your positions, you'll be able to see a stop loss has been set here. You can change this also,
show me that slide.
the stop loss. So again,
Just
click here and
okay. Just
add a stop loss here. And to add a take profit,
we can change the figure. The stop.
yeah, you can, you can. So let's say instead of 500, make it say 1000.
What is the point 3 there? Okay.
Yeah, this price will get calculated.
Yeah, it means like if the price come 1000, you have to go sell that.
Correct. So you modify, you click, remove this, modify, close.
Modify. If you don't modify, it will not go up.
Yeah, you have to modify the trade. If it is modified, you will be able to see the stop loss updated. Right.
And this P&L column,
Yeah.
is this the net P&L or has it factored in your holding charges?
No, holding cost is still not charged because we have just taken the trade. Holding cost will be only charged
once
after,
I exit
yeah.
the trade or once the position closes.
Holding cost is charged around 1 a.m. if you're still holding this trade. So you can open your trade even now, but if you close your trade before 1 a.m. in the night, you will not be charged holding cost. If the position is rolled over for the next day, it will appear.
That will show on the
That will show here on the history. Yeah. So if you remember yesterday when we were doing technicals, right? Remember I put an order for gold to sell at higher. See what happened. After we left, somewhere around here, the buy trade around 6:15, it got triggered 30 units at 3040 and the take profit hit right here. If you see sell trade, no, buy trade close, 3028 is where I bought, 3040 is where my take profit got hit. See, this says TP 3040, around $360 profit, which we earned on 30 units. This when we were doing the technical charts and understanding how it will go on resistance. If you see the same gold price today, this was the chart which we opened, right? So we were looking at a 30-minute scenario. Even now also, if you see this, see, this is 3053, 3054, but if you see the actual resistance, 3050 here, and look at this buying level. Such a wonderful buying level, right? 3028. Can still put your pending orders. Put a limit order to buy 3028. Keep a stop loss slightly below this. Keep your take profit at again 3045 or 3037. The probability is very important when we are doing day trades.
So we can do a limit order, we can do a stop loss, and we can do a take profit.
You can, yeah, you can do it. At once you can do it. You can just prepare an order ticket, which will allow you to place a limit order, put a stop loss, put a take profit also.
And the same pairing or strategic pairing that you can do. You can do that even in FX pairs also, right?
So currencies used to be a very good form of arbitrage. The only problem is now because interest rates are really high. So if you were to do pairs in currencies, you will end up paying a higher holding cost than some pairs. Holding cost now is higher because interest rates have increased. See, from 2010 or 11, so I will always give you references from 2010 or 11 because that is when I was introduced to the industry. I was 21 back then. So all my references come from that point. Like sir has seen before 2008, his references would come before there. But in my case, back then the interest rates were very low. So I grew up in this industry looking at very lower interest rates. So post 2020 or post 2021, it was very new for me also to see that interest rates have gone up by 5.5%. So maybe earlier we would do currency arbitrage, but now in this case with higher interest rates, you might end up paying more of the holding cost rather than. Plus these days, currency pairs are very less active. We have tried to, so how we create a pair, it's not randomly. We took two pairs, we tried to find out the correlation between them. Now obviously if it's a South African index versus US, there is no correlation. But we try to statistically see their returns, that how often they have outperformed or underperformed each other. Then we do a back-tested analysis on Bloomberg to see that if somebody had done this trade in last 20 years, how this would have panned out. If it shows majority of the time profit, then we pitch it to the clients. Because there are many pairs which we could work with. One is Brent WTI. There is sometimes Brent and natural gas also, where you could earn more interest than, so you short sell natural gas, you will earn interest over it. And that is where that strategy would work out. Between gold and silver, there's a pair between wheat and corn also. There's a pair between platinum and palladium also. In fact, in cryptocurrencies, we found a pair between Solana and Ethereum also. So a lot of this goes into research. That is the basic difference between having a consultant and actually having just a CFD account. So far, whatever we have talked about, we have not talked about day trading at all. Day trading is something for which you do not really require a big book. You just need to look at the prices. Now, last 3 days at least, gold is one of those products which we have seen enough. Maybe another 7 days when you try to track as much as you can, and you will realize that now these 10 products, you have seen enough. Now, if there is a dip, you will know that this is a dip to buy. You don't even need a person to look after it. You need a consultant to look into more strategies, more pairs, like, uncharted territories which you would not know. So these kind of strategies you can try in your demo accounts also. First, try in demo accounts, see what is your experience like. Like today, if I have taken, like yesterday when I put a technical trade over there. So see, right now we are looking at this. Looking at gold, profit of $72, silver loss of 193. But if you see overall net loss in gold silver, it is still around $60-70. It will remain like this until the ratio drops. When the ratio drops, you will see one of your position is showing more profit than the loss of the other position. That is where you close your trade. Obviously, that profit has to be more than the commission which is charged to you. But that is why higher volumes are really important. So with strategies, you can do it. The consultant can also show you an exit plan, that where you should take an exit. Strategy is not something which you just hold on to it perpetually. Sometimes the trend may move from the ratio. Instead of going down, it could just keep going higher. So you plan your exit accordingly. It is really percentage wise. So,
It's the amount of margin that you will use.
correct.
I mean, if you have 100,000 in the account,
Yes.
how much can you buy?
With gold and silver both, like for example, in silver, in gold the leverage is 100 times, but so in a $100,000 account could actually end up buying $10 million worth of gold. Obviously, we do not recommend that, but in $100,000 you can easily buy gold worth 200 or 300,000 very easily. Same goes for silver. Silver leverage is not exactly 100 times, somewhere around 50 to 60 times more you can buy. But again, 200, 300,000 worth silver also you can take. So you can do this strategy in a bigger value, and that would still be conservative.
So the margin will be added, is it? The amount you bought gold plus the amount you bought silver. That's the amount.
Both the margins will be used.
But in bull call spread, they only count once.
So bull call spread, what happens is when you buy a call option, a certain premium is charged, right? That becomes the margin, the premium which you are paying. But when you sell a call option, you receive something. So whatever is the net premium is what is charged. Here it is different. Yeah, here it is different. Here, from whether you buy or short sell, in both the cases, margin will be used together. It will not be neutralized. So option is slightly different from this thing. So in options, what you are using as a margin is basically the premium. So let's say if $8 is a premium and 100 shares is a lot, you will end up paying $800. That will be what is required to enter into that trade.
But the risk is what happens if you get assigned?
Sorry?
If you get assigned,
Yeah,
when it goes below the value upon expiry,
correct.
then you get assigned.
You take the delivery of the stock. Yeah, when the option expires. But before entering into it, there will be a premium which is there, right? So when you buy an option, you pay a premium.
The premium is okay.
Yeah.
It's little.
Yeah.
But once you get assigned, you will need to borrow from the
So you're saying that can we top up that the already bought position? Is that what you're talking? Topping it up?
No, you will be in margin, right? Once you get delivered.
Once you get delivered, correct.
Margin.
Correct. But there, because you're doing through interactive brokers, if I'm not wrong, so in the delivery of the option, the margin usage is 75 or 80% in interactive brokers because it's a direct exchange-based platform. In interactive brokers, the margin which is used when you are buying a stock, if it is a margin account, it is at least 75 to 80%. In this case, gold or silver, it is 1%. Leverage is obviously higher in these kind of platforms. You understand? So here when you are buying, you're depositing 1% of it. In interactive brokers, when you're buying a stock, you will end up at least 75 or 80% of the margin which will be used for the stock.
So the leverage is less there.
Leverage is less there. Leverage is much higher here.
If you have 100,000,
Yeah.
how many of Alibaba share can you buy?
Sir, most likely
Alibaba is
100,
14,
105,000 or 110, not more than that.
So little.
Yeah.
You can
Because
only buy you try to buy one Alibaba share?
in interactive brokers, you're asking, or here?
What is this?
This is a different platform. This is more of a derivative based.
It's a
CFDs, yeah.
Oh,
Here,
interactive brokers.
yeah. Interactive brokers it does not give you any leverage. Very less.
Sure.
Very less. I have the account with interactive brokers for long term. So it does not give you a very high leverage.
So to buy one Alibaba share, you need to deposit around 140.
Exactly the amount. Yeah. Almost the same amount. See, exchange-based brokers have an initial margin and a maintenance margin. So whatever you are buying, around 75 or 80% is the initial margin, and then there's a maintenance margin of 20-25% which is needed. So in exchange platforms, the leverage will always be less. But in derivatives, you get higher leverages. So here, if you buy Alibaba shares, you can get a leverage of at least 5 to 6 times very easily.
Interactive brokers, I got quite good margin leverage actually.
I don't know. So you have interactive brokers?
Yeah,
here?
I have, yes.
How much is it?
Let's see, it depends upon which shares you have, okay? Internet broker
Yeah,
is
yeah,
smart.
some-
If you're buying some the volatile shares, okay, they will not give you. For example, if you buy some good shares,
Yeah,
like
yeah.
Amazon or
But
so,
not
then you
95%.
can get it.
Not 95%.
No, then you can.
I mean, if you buy like the Magnificent Seven, they give you very good leverage.
Okay. Because I have the IB Care account. I never put.
And S&P 50, in fact,
See,
Try to check. I feel
If
because.
for IBM, for example, for
Because-
IBM shares,
Yeah.
okay?
Yeah.
For $10,000, you can buy $40,000 also. Because they keep 20%, like.
Yeah.
And they sell out. I don't want to say they sell themselves.
I don't know.
and the funds, if you don't use, they give you interest rate. Also, right? They give you.
That is there.
But if you have
Then,
some
no, not here. Not here.
But if you have some stupid stocks, okay?
Yeah.
no leverage there.
Yeah,
they're
because
smart, they know
yeah,
what to
yeah.
do.
See, I also have the account in IB Care. I've never seen a very exclusive high leverage in it.
No.
But here in
Like
this
you
case,
have
yeah.
$25,000, okay, you can get 35, 40, 50. depends
Correct,
upon-
correct,
But if you invest in the good shares,
Yeah.
like I got Rolls Royce, okay?
Yeah, yeah.
You invest in Rolls Royce at $100,000, they might give you 300,000 immediately.
Exactly. Yeah.
Depends upon, they're smart, they know where to give.
Yeah, yeah.
They're not going to lose their money.
With regards to interest rate, yes, they definitely, if you have signed up for an interest account, you keep your money there, they will pay you the interest. But there also, I think residence is a restriction. So the interest rate, I think the interest account is for specifically people who sign up for a interest account, and when they approve it, you can earn interest on it. Yeah, I think that is there. But in these kind of platforms, you can take higher leverage. See, when you see markets coming down, and that could be a time when it comes down, and if there is a immediate 10-15% recovery expected, that is the time when leverage can be really helpful. Because that is the time when you can earn more with a sudden spike. Like if Tesla went up 5% yesterday, if you had even levered 2 times and took a trade, you would be earning 10% on your money right now. That is the idea. When markets fall a lot, leverage platforms really help you out. It's around 232 in the pre-market, right?
So Tesla is good to minus 3% minus now.
$3 down from
For example,
yesterday.
if you buy Tesla shares in Interbrokers for $10,000, you can get $20,000. Like,
Yeah, only that much. Because for me,
depend on it. See, total, you get total figure later on how much you get of leverage.
yeah,
But if you have got 10 spreads, okay, 10 different stocks, okay.
Yeah.
Some stocks are stupid stocks.
Yeah.
From them, okay.
Yeah.
Very volatile, okay. Today,
They will not give you leverage.
Tomorrow will two.
yeah,
You'll not get anything there.
Yeah,
You don't even consider.
Yeah.
When you have $10,000 there, okay.
Correct.
It's zero.
correct.
Okay. But if you have Tesla, if you have Rolls Royce, you have Siemens,
Yeah.
okay, you can get double, triple.
Correct.
At least you get 3 times.
Oh, yeah, these interactive brokers, they allow you leverage, but you have to pay a percentage. You have to pay.
Yeah, it will have a.
CFD,
You have to pay here
you
also.
pay percent
Yeah, you have to pay interest rate. See, if you take,
Borrowing is like loan.
but here in this case, if you take leverage, if you hold on to the trade till 1 a.m. in the night and you roll it over, they charge you the interest day on day. So any broker which will give you a leverage, it will charge you interest.
How much
Interest.
interest? Actually? How much interest by leverage?
Interest is charged, let's say in stocks, for example, it is 7% right now
7% per
Yeah.
annum?
per annum. So whatever is the value of your trade, say $100,000, 7% of that divided by 360 is what you charge today if you hold on to it.
Okay.
You hold on to it for 10 days,
Like
you'll be
if you
charged
get $20,000, okay, so 7% how much?
1400,
1,400, okay.
1400 divided by
Divided
360
so that means you charge per day.
per day. Yes,
If I close the position immediately,
you will not be charged
you'll charge the same that day only.
for those days.
Those days.
If you buy it today morning, you close it around 12 a.m., you will not be charged. Do you hold on to it for 1 or 2 days, you are charged every
Per
day. Yeah.
You charge 7% for that.
Correct. You're charged for that particular day.
So when you buy gold and silver, you'll be charged.
Yes. If you're buying gold spot contract, yes. If you're buying a future contract, future is a derivative which is in the exchange. Futures do not have holding cost. So future contracts is a derivative which allows you in exchange take the delivery of the asset,
You buy the premium.
after the contract. But that again, the price is at a slight premium, but they don't charge you the holding cost. So either way, whatever is your decision, if you don't want to pay holding cost, you pay a premium and just hold on to it. But a lot of people don't mind doing spot contracts in gold these days.
Risk factor you take basically.
Risk factor, is it?
80%, 20%. For example, just wait, only
Yeah.
one share, yeah, okay?
Yeah.
Only one share. I invested $100,000 in this.
Correct.
Essential finance, okay?
Yeah.
I take a leverage of 400,000.
Yeah.
Okay.
Yeah.
It become 500,000.
Yeah.
Now, when you do a stop loss by yourself,
So for
like 80%, 20, 90% or 20.
so normally
But you have to take a stop loss.
over a day, I would not want to risk more than 2%
2%, okay.
in a day. So right now, whatever trades I take, I do not exceed my loss more than 2%, because that way I can do 50 trades.
Yeah. No.
All 50 needs to go in a loss before I lose my entire money.
Questions are okay.
Yeah.
I'm a stupid investor, for example. Stupid and good investor. Okay. I invested 100,000. I take a borrow from you 400,000. Okay.
Correct.
Fine. But I can lose all your $4,000.
Correct.
My $50,000 also.
Yeah.
You understand what I mean?
Correct. I understood, sir.
So in that case, what is the stop loss? By
So-
system itself.
So by system, it is set at 50%.
Okay.
So for example, if you invested $100,000, you bought something worth 400,000,
Exactly. Yes.
for which you blocked say $40,000
Yes.
from your end. Rest 360 is mine. Rest 360 is mine.
Absolutely.
Yeah.
That, yes.
Now in that case,
You can't take a risk of 360. No,
Yeah.
My $40,000.
yeah. So in your case, you had 100,000, you kept 40 as a margin, rest 60 is remaining, right? So in our case, the moment your account value from 100 comes down to 20, which is 50% of the 40,000 which you have put with us, your account will be closed out.
I mean, you'll close. No, not close. You'll close.
Position will be closed out.
You'll close the position.
Yeah. So whatever is the margin you have put, loss reaches 50% of that margin, position is closed out.
Yeah.
So we,
System will close, right?
yeah, system will close it.
Exactly.
Yeah.
That's my question.
Correct. System closes it.
You
So
cannot take a risk, no, for me. I'm a greedy man, so I'll take a risk.
it will never happen, sir. So many times people ask why you are giving us higher leverage. Brokers never make a loss.
I know that. That's what I'm saying.
Brokers would never make a loss. Even if I give you 1,000 times leverage, I am giving you leverage, allowing you to place a trade. But the moment your loss becomes 50% of the margin which you have deposited, position will be closed out. In this case, there is one twist. If your broker is a B booker,
Okay.
which means he is not passing the orders to the LP, in fact, maintaining his own book, taking trades against you.
Okay.
In that case, there is a problem because sometimes the system does not hit and your account value could go negative,
Okay.
which means you are liable to the broker to pay for the losses.
Okay.
So it is always good to work with A booking models where your order is passed on to the LPs. So in our case, when you put the order, even goes from our inventory, but we pass on that order to the liquidity provider. Liquidity provider passes on to another LP and eventually to the market. So in our case, our only revenue is the transaction cost and the spread what we charge you, or the holding cost markup what we charge. We will never make money out of your loss. But in case of B booking brokers, they are the one who are countering the trade against you. So you really need to make sure that when you are doing something like this, that is why these brokers are able to give you 1,000 times leverage also. ESCA regulated brokers cannot give you more than 100 times leverage. It is not possible. Because this used to happen in 2015 and 16, but in 2018, ESMA, FCA, ESCA, all of them came together under regulation where they said that retail investors will not get 500 times leverage. Because a lot of people would not understand how leverage works and eventually end up losing money. So now 100 times is the best what you get with regulated ones. The ones who are not regulated will take cash also, will allow credit facility, will give you a lot of things. But that would not make sense for you.
Okay. Just to answer your question, because the internet brokers, okay, depends on what stock you have, they will invest in you.
Yeah.
The stocks are very good, okay, established one. They're sure they're going to lose money. They'll give double or triple. Some stocks, they're not sure about, zero leverage.
Possible.
Yogesh,
Yes.
do you guys also have a forecasting tool here to see between the spot and the future? Suppose I want to do a future instead of doing a spot. What would be the forecast if I have to buy a trade at a future rather than a spot?
So when you say forecast, does it mean
To
Like-
exactly say, if I want to buy a future 2 months, for a
Yeah.
future 2 months or 1 month,
Yeah.
rather than buy a spot which is 2 days.
Correct.
How would you see that, that commodity or the trade?
So future contract, you can see from the products. So let's say, for example, if I write coffee, coffee has a future contract which will expire on 11th of April. So you could see the expiry of the contract, you see the future contract and the price. So this is coffee in future contract and this is coffee cash. Yeah. So if you see spot right now is 392, future contract is 388 at the moment. So if you buy Arabica spot, you have to pay holding cost to it. You buy future contract, this will expire in 11th April, so you don't have to pay any holding cost at the moment.
And on 11th of April, that will be the delivery.
In exchange, it would happen, but because you're using a CFD platform, so it will be cash settlement and your contract will be closed. So whatever is the profit or loss, it will be cash settlement, no future deliveries. But normally that is how a future contract would work on exchange.
More like a strike rate. Approximately.
Yeah, it's just you don't have the option to abandon the contract. While future contract is more enforceable, cannot back out. Option you still have the choice to back out of the contract, but it works similarly.
This platform is a different platform from interactive brokers. It's CMC.
Yeah. So this is a CFD based platform.
Okay, CFD based.
Yeah. So if you want to buy gold, silver, currencies, cryptos, this should be used. For your options and stocks, what you're using is right. Interactive brokers, that is the
So
good one.
for this platform, you have consultant.
Yeah,
How many
exactly.
consultants do you have?
Sir, as of now, I have at least 30 consultants. Each one of them handles around 50, 60 accounts because all of them are trading like every day. Some of them are long term.
50 accounts on average. They will give stock ideas every day.
Yeah. So we have research which is already, research is separate.
The stock ideas, are they more or less the same for all the clients? Or?
So different because your objective would be different. Like if I have somebody who's more aggressive towards tech, then my ideas are different. For you, if you're more of a dividend income kind of a person, my ideas will be different. So that is the idea of having a consultant on your own where you can talk to them and ask them whatever is yours.
How do I choose you have how many consultants? 50. How do I choose a better consultant? Is there a ranking?
Meet them, always meet them. See, normally what I do is I talk to you.
The more experienced one or
Sir, a lot of
percentage
them.
success?
So what we normally do is, because this is more of a, it's not a fund, right? Because it's not a fund, it will be very difficult to identify a success ratio because these are not hedge fund managers, right? Otherwise we can value them. We can always, but most importantly, it is needed that when I speak to you and I understand what you want, then from my expertise, I would pick a consultant and then I'll make you meet with the consultant. If you feel that you have conveyed and the person has understood, that is good. But if you feel that you want a change of the consultant, we can do it also. Initially, it is always based on the relationship manager's interaction with the client, what we have understood of you and what is being communicated. And then we pick a consultant and make you meet with the consultant also before you even enter into any kind of transaction with us. Because you should have a rapport, you should understand each other and only then proceed further. If you feel there's a communication gap or this is not the right consultant for you, we can always change it. But
So
yeah.
what is the commitment? I mean, what's the fees? Or what is
For
the-
consultants, not. Everything what we charge is commission, holding cost, spread.
But I have to trade using your platform, is it?
That's true, sir.
That's
There's
the
not
only
separate
requirement.
consultant. That is the only requirement.
I cannot use my own interactive brokers to trade
So,
your
see-
ideas.
In this case, because you're also connected to interactive brokers,
Yeah.
you will just have to assign that account to us through email. And once we have your interactive
Have
brokers,
visibility to all my.
we'll be able to monitor your positions. In case of interactive brokers, it is your same account. Your money and everything still with the interactive brokers. Account is mapped to us
The fees will be slightly higher.
slightly higher.
How high? How high?
So if today, whatever you are paying to interactive brokers without a consultant, with us it is charged 23 cents per share, which is higher than normally what you pay to interactive brokers. I think $1 per transaction as of now. I don't know how much you're paying, but if you check later on, I think Interactive Brokers charges $1 per transaction. But
No, I think 0.003 something.
yeah, but in our case, the fee
$15.
increases.
But 10,000 you get $15.
That was for this platform. With Interactive Broker, it changes.
0.003, I think. The 30,
Yeah.
30.
For Interactive Brokers, we charge 23 cents per share.
So
Yeah.
I can have two accounts. One
Yeah.
I will register with you,
And what is maximum?
then I can have another
You-
account register with you, and then I can do trading on both accounts, right? With your
You
stock,
can,
yes.
you can. See, eventually you can. I mean, if you have one account mapped to us, now it is, ideally we would want both the accounts mapped to us. So whatever trade you are doing, we earn commissions out of it. That is what would we want. At the end of the day, if you have assigned one account to us and you're doing trading in a separate account which is not assigned to us, so obviously you're saving commissions on it. There's nothing much we can do. But in an ideal manner, it would be great if everything was assigned to us and we give you the idea, we also earn, you also make money. That will be the right way to do it. But you can do whatever you wish. In our case, because Interactive Brokers, we are connected to, so we can actually provide you ideas and a good option-based strategies also. We have people who have done a lot of options trading. So if you want option-based ideas, we can even provide you that.
You said 23 cents per share. Huh?
Per share, yes.
And what is maximum?
So if you buy like 100 shares, $23 charged because it's per share.
No, come on. Some shares are costing 0.5 cents also.
So Interactive Brokers, we don't make.
No, I'm not saying it.
Yeah.
In your this platform.
In our case, it is 8 cents per share, and minimum is $10.
That's right. That's why.
Yeah, that is
Internet
it.
broker same, no? Do 23 and minimum one is minimum.
Minimum will be 23 or more, because here minimum is 23 cents per share. Interactive Brokers shares commission is slightly higher, because Interactive Brokers we don't earn on spread, we don't earn on holding cost, we don't earn on anything. It's just the commission. Plus, Interactive Brokers, a lot of people use only for buy and hold. So there is not much revenue for us. So we charge only on the commissions. When it comes to option-based trading, we charge a separate commission on the options lot, which is apart from the premium.
No, why ask the question? If I assign you the internet brokers, okay?
Yeah.
In that case, I will know exactly how much.
Yeah. So 23 cents per share is the commission which is charged.
Okay. And what is maximum for that trade, per particular?
Sir, maximum when you say?
Like say, I got 100 shares, okay?
Yeah.
100 shares will charge
23 cents per share.
23, it's like your
$23.
okay?
Yeah.
Okay. For one trade,
Correct.
okay?
Correct.
But suppose I have a share which cost is only
23 cents.
23
Oh,
cents,
yeah.
20 cents or 50 cents.
Yeah. So it will be same, $23 minimum.
Okay.
It will be the same. Because that is the
So that's why I'm
only.
asking, what is the
yeah.
maximum charge? Like a 1% of the value or a 23% per share? Like
So
that.
it's per share, 23 cents per share. It's not percentage size, it is per share what we charge.
And the maximum,
Maximum up to you. It increases with the quantity.
see, if the cost of the share is 50 cents, okay? There are some shares.
But I understand
right?
there are penny stocks which will have 50-cent charge, right?
Exactly.
So I will not advise you to do that through us.
That's what the
Yeah,
question.
definitely, I understand. So if there is a stock which is 5 cents, for example,
Yeah, exactly.
you end up buying 10,000 shares of that.
Exactly.
So I will not charge you 23 cents. I will tell you not to do that with us. It will not be worthwhile.
Yeah, exactly.
No, definitely, sir.
In such case, you should have a maximum amount. Also.
Yeah.
Maximum charges.
Yeah.
And then it's minimum $10.
Minimum $10 here in this platform. In Interactive Brokers, I can actually send you a commission sheet because we have a very standard charge for IBKR, Interactive Brokers. And it is mostly on stocks and options when you trade. But 23 cents per share is what is
There's
charged.
no need for me to open this account, right, if I already have Interactive Brokers.
If you want to do trades in commodities and indices, then this account is essential because currencies, cryptos, commodities, gold, silver, this can be done as a commodity based trade only on this platform. On Interactive Brokers, you can do stocks and options. You can do future contracts of commodities, but again, leverage will be very less.
Less risk.
Less leverage, yeah. But you can do that.
Less risk.
Yeah.
difficult to manage so many.
Up to you, definitely, sir. See, this account will be mostly opened by people who would want to do higher leverage-based trades.
More aggressive.
Aggressive also. If you have a long-term thing in your mind, Interactive Brokers is working out for you, not a problem. That is okay. In our case, obviously, when it comes to strategies, this account is easier. If you want to do Brent, WTI, spread trades,
You can still do it.
it will be in form of future contracts. Yeah, I mean, see, if you're putting that kind of money, you can, because one lot will be $70,000, $80,000 there. You're putting that kind of funds, you're doing it, you can, definitely, sir. Not a
This
problem.
one easy for option.
This doesn't have options right now, but we are going to introduce soon. Till then, we are also using Interactive Brokers to provide options.
Tell you because I do the book call.
Yeah, it's very good. So, IBCAR is best for options as of now. We are trying to get more liquidity for our platform also. Once it is there, we'll definitely switch to this, then that.
So currently your platform has only gold cash, and does it have futures also?
Not now, because future liquidity is not available. Since last 1 year, it has been difficult for us to not available. As of now, the future contract in CFD is very difficult to get because
And price between spot and futures for gold is roughly around 15 to 20.
yeah, currently right now there's a lot of arbitrage.
Is there a price variance?
Yeah, in silver it is going on right now. So silver spot and silver future, there's an arbitrage possibility going on. There is a 60 cents difference in future and spot. And if you see next 40 days when the contract expires, eventually the future will merge with spot. So right now a lot of people are able to do that arbitrage. It is much more safer than Brent and WTI or gold and silver because it is silver future and silver spot. So it's literally the difference at which you are entering. If it converges, you end up making money. But then there's a holding cost factor also to it. So that is there, but you can do that. See, ideas like this would make more difference.
So silver is only cents, huh? It's only the difference between spot and fixed.
66 cents right now, yeah.
But for gold it is more, right?
Gold, I think gold future and gold spot, the difference of at least $20, $25. Yeah, it's much difference.
That's way too high. No?
See, that is why silver arbitrage is a much safer option to go for. And again, these things do not happen very often. Like not every day I talk about silver arbitrage, it's whenever it happens. So you can always try that out.
Thank you.
Right, sir. So, thank you so much once again. If you have any questions, you can.
I came late because I not got the Zoom link. That's
Oh, okay.
I was able to attend yesterday. That
Yeah.
was within lot of
Whom you were in
I was
touch
still,
with?
WhatsApp will no reply.
Who, where, which number you were WhatsApping on, just for the future reference? I can make sure that.
Same I got in WhatsApp also. Yesterday I
Was there a dedicated person, or you were messaging at the company's number?
I think this Century Financial Company number. WhatsApp. Yesterday do I got and
Okay.
today I was
Century
unable, so
Financial
I
Institute.
came.
No problem. So we have recorded this session also. I'll send you the recording. I'm so sorry. Right. So just practice at home. I think it would work really well if you're able to put those many hours. Again, you don't really have to sit for hours and hours, but every 25-30 minutes, just glance to your watch list. Do it for a week and see if there is a change in your understanding. That is all I am saying. Start with 4 or 5 instruments, move to the watch list finally, and just try to see if there is something. For stocks, see day on day progress. If you feel that it's too riskier for you to enter into a stock which moves $10-15 a day, just reduce your quantity and experience it yourself. There will be no better experience than you looking at a price movement on your own. That would really help you out. Like Netflix, last week I saw 850. Right now I'm seeing 930. It's moved in 1 week by $70-80. Even if I had 5 shares, would make me $350 like this. So more you track it, more you will get a hang of it, and you will know whether it is at a discount or not. April is going to be an earnings season. April is the month when the financial companies, a lot of companies actually are going to show their results. It is a really good time to trade in stocks, especially when the earnings are coming out. Because if earnings come good for a company, you see a increase in the stock prices. And that increase could be directly proportional to the earnings surprise which we have received. Like last quarter, Netflix had a great earnings and the stock moved up $100 in one night. So next morning, Netflix opened up a $100 gap. So you could enter before the earnings if you feel that the earnings are going to be better, and you could earn over that. But try to diversify as much as you can.
The timing of US market open.
Hmm.
See, now currently, I think now we are in the summer, so it starts at 4:30 or 5:30.
Stock market opens 5:30 summer timings.
Stock is 5:30. What is it? What
4:30 is so 4:30 is when a lot of economic data starts coming out. Jobs report, GDP numbers, retail data. That impacts a lot of your trades which are in commodities and currencies and indices, broader indices. Some data are really important, like the jobs report, which is non-farm payroll, inflation data, which is CPI data. And a lot of these reports are directly connected to the central bank's decisions. The central bank would look at those news, and then there are FOMC press conferences, like Fed press conference, which happens 11 p.m. UAE time,
That happens very
10:30. Correct.
But, no, my question is, so which market open? When I say 4:30 time, 4:30 Dubai time,
Yeah.
is it the US traders who open
US
markets,
traders.
or is it the London traders?
Is the US traders. So there are three major sessions, right? First is the Asian session, right? Japan opens 3:15 in the morning. By 10 or 11 it closes. Then 1 to 5 is London. That is the peak session. And then 5 to 11 in the night is US, Dubai time again. These three sessions are really important. The great part about US session is that when 5:30 p.m. US markets are opening, UK and Europe is already open around that time. It's still 2 hours before it closes. So there is a session overlap which allows maximum volatility. European and US traders both are there on the floor. So you see a lot of volatility around this.
6 to 8.
Yeah. So basically when you are done with your work, you're home, you could still experience a lot of volatility. In Dubai, trading is wonderful because if you get up morning 4 or 5 a.m., you will see movement happening. Then 11 a.m., again, Europe and UK opens. 12 p.m., a lot of European UK data comes out. Then by 4:30 p.m., again, a lot of US data comes out. 5:30 US stock opens, which closes at 12 a.m. then. So till morning, throughout the night, you will have 7:30, 7:40 p.m. around 8 o'clock. But you'll be able to get maximum volatility when you are here. You will not get this much volatility even if you're trading from US. Because by the time you get up, you start looking at the prices, it is already closed. Or if you're coming back from work, it is already done.
Okay, sir. Thank you.
Right? So,
I already opened an account.
no, that definitely. So, I mean, see, the idea of these sessions was just to spread more awareness. We keep doing these sessions later on, webinars, seminars. If you have any questions, we can have more one-to-one sessions also. Please feel free to join. We are active on Teams and Zoom also. So if you want to have a one-on-one session, we can definitely sit one-on-one and have Zoom sessions also. Just pick a day and I'll be available. Right? Thank you so much.